All right, you're looking to buy a new home. Your problem is that you've got to sell your existing home to get the equity you need to buy the new home. Common problem for home buyers in 2025. I'm coming across a ton of these clients. So what we're doing today is talking to my buddy Tyson from Lensure. Good to have you, Tyson.
Good to be here.
And spoiler alert for anybody listening, Tyson's going to answer any and all questions I have about their Boost program. It solves this problem. And just to not, keep the cat in the bag for people that are listening to this, if you're trying to buy your move up home first and you need the equity from the house you're leaving, this Boost program is the solve. I've got clients asking me, I've got real estate agents asking me, and so we're going to dive into it today. First and foremost, short notice, Tyson. I appreciate you joining me. Thanks for joining me today, man.
Yeah, no, of course. Like we said, we've been planning for months, so I'm excited to be here to finally be doing it.
Okay,
great.
Yeah, and I don't like leaving stuff until the end and holding back the secret. So I think jumping right into it's probably the play here. I'll explain it how I understand it and give people kind of an overview of it. And then I'm going to ask you specific questions just so that people get a feel for if it's a scenario that they're looking to implement. They're going to have questions about cost. They're going to have questions about timing. They're going to have questions about, how does it affect, DTI ratios and things of that nature. But I think this is a very common scenario, and I like using real numbers. I think people relate to that. You own a home. It's worth $600,000. You only owe $300,000 on it. And so when you're looking at the replacement home and you're like, this new neighborhood, one more bedroom, this place would be perfect for $800,000. The only problem is your down payment on the $800,000 home is locked up. It's the $300,000 you have in equity in current home. What this Boost program is going to allow you to do is access that equity to not only put the down payment that you need down on the replacement home, but allow you to qualify, without taking into account that mortgage payment you currently have on the current home. I left out some of the details, but we'll jump into them. Tell me this Boost program from your standpoint as a lender who does these and does them at a high level. What did I miss?
Yeah, no, absolutely. So I mean, the basics you covered really, really well. I'll dive into the mechanics here a little bit. Really to conceptualize what the Boost loan is, I want you to think of a cash out refinance on the house that you own today. So $600,000 house that you own, we're doing a cash out refinance on it. And conceptually, that to me is a pretty easy idea to understand. Usually the pain point is a cash out refinance has a payment. And most borrowers can't qualify for two mortgage payments simultaneously. And that cash out refinance also usually can't be executed when the property is listed for sale, which it more than likely will be because this client wants to move. The Boost addresses both of those. One of my conditions prior to funding is that the property has to be listed for sale. So we know what you're doing. It's very out in the open. It's transparent. We're not burying that at all. The second piece is we do not charge a payment on our Boost bridge loan for 12 months. It's a 12-month balloon note. Not only do you not have a payment due every month out of your pocket, we do not calculate a payment on our DTI calculation for your new purchase loan. So it's a cash out refinance that you're not making monthly payments on. We're not hitting you for a monthly payment. It's as if you've already sold the home and have purchased your new home and you can go non-contingent.
Yeah, which is what people want. They're like, in a perfect world, I'd sell this house, I'd take that money, I'd buy this house, but that's not how it works. And I think that, this program solves a lot of problems because I had this conversation with a real estate agent yesterday, and he was like, if you're in a situation where you're buying the new home contingent, because you can't qualify for both. So it's like, hey, we're contingent on this thing selling. You're generally going to have to offer better terms, pay more for the house you're buying. And then once you've got that offer accepted, you're under the gun, like sell this thing in the next 15 days. You're probably going to have to sell it at a discount. And so like you're getting the worst of it in both ways. This solves that. You got 12 months to sell. So you can remove all your personal items from it. You can clean it. You can stage it. You can get top dollar for that. And then when you buy forward, now we're buying non-contingent. which means, your offer is more competitive, more likely to get accepted. So I love it, man. What I want to ask you and what came to mind as I'm putting this stuff together in my head, I love real numbers. So again, in our scenario, we've got a $600,000 house that we owe $300,000 on. With me looking at it as a cash out refinance, what's the maximum loan to value that I'm able to grab from that, departing residence in your boost program?
Yeah. So we can go up to 75% loan to value to put our bridge loan amount at about 450 grand.
Okay. So when we say this is what we're looking to do, we're gonna sell this one after we've closed on our forward purchase. Your bridge loan is going to be like 150,000 that we have access to, because the difference between what we owe and your 75% LTV is 300 and 450.
Yep, correct. So I'll refine that a little bit. So what we want is to truly unlock that non-contingent offer and for there not to be a payment. So we're going to jump in with a $450,000 loan. We're going to pay off the $300,000 that this potential client owes, and then give them the 150 to use towards the purchase of the new home.
So they're truly getting their net proceeds. They're saying, exactly, this is paid off. Here's your net proceeds. That's awesome. And I know the answer to this question, but I want to ask it so that real estate agent partners can hear this. It's going to act like any other sale. Once that forward purchase is executed, you've taken that 150 that's proceeds. You're putting 15% down in your $800,000 purchase. You're covering the down payment, closing costs. You're settled. You're good. Now the real estate agent gets tapped in. You go sell this house. You structure the commission. You structure, your sale and the commission involved how you would in any traditional sale. There's no limitations on that sale, correct?
None whatsoever. Our interest in the property is helping it to sell as quickly as possible so that it's off our books. We want it gone. There's no weird hair on it. Now one thing to add and kind of point out here is we do charge interest on the boost loan. Interest is accruing on a balloon note. So if this property took 3 months to sell, the borrower's paying interest. The rate is 9.25%, because I know you'll ask. They're paying interest at 9.25% for those 3 months until the property sells. What's great about this compared to other bridge loans is I'm not cross collateralizing. So the sale of this departing property has no impact on the future purchase. There's no cross collateralization. We're not releasing a lien from one or the other. We're not merging the two together. It's pretty simply, hey, we just need to sell this place within 12 months, pay it off, and you're good to go.
Okay. Yeah. So in our scenario, 450 is the loan amount at the onset. You got $2,200 a month or whatever that number is of accruing interest. It sells after 3 months. The payoff, 456.6 or whatever that number ends up being. And then you sold it for you cleared it out. You made it pretty. You sold it for 615. So congrats. You got an extra 15 grand in close. You're not sweating the 6,000 in interest. And for borrowers listening, once you close there, you pay some title fees, you pay some agent fees, you net another 130,000 or whatever that number ends up being. I guess this is another question for you, Tyson. Do you guys allow a recast? Can we take some of that money, throw it at the mortgage we did on the forward purchase and recast it?
That phenomenal question. I unfortunately don't allow a recast. But what I'll tell you that I see a lot of loan officers doing, because this is a great program for full doc clients who say, like, the reason they're with me as a lender instead of working with another lender is that they're using a bridge loan. That's the whole reason. What we've seen a lot of successful originators do is take that 100,000 of proceeds after the sale of that home, and after the borrowers have observed the early payoff period, it's 6 payments that you need to make on this new forward purchase. You swoop in with a refinance to get them likely more favorable terms, with $100,000 down and secure a more permanent financial mortgage for them.
Yeah, I like that. And so especially in the season we're in right now in real estate, rates are higher than most people would like. They're projected to go down. So just to recap that for people, you bought at 800, you put 15% down, so you've got a $680,000 mortgage on the new house. You got a small little mortgage insurance premium because it's 15%, not 20, and you have a 7.375 interest rate. What you're going to think about, and a great lender is going to coach you through, is after you've made 6 payments on the new mortgage, you've sold that old house, you've released that remaining equity in the home, we're going to look at what's called a cash in refinance. People hear the term cash out all the time. They're like, what's a cash in? Well, it's what it sounds like. Instead of taking cash out, you're putting cash in. And so, you've got this extra money, and we look at it and we say, you know what, like, keep the 30 grand to get a couple credit cards paid off and put $10,000 in the bank, but let's throw the 100 grand at your current mortgage, go down to 580,000 on this house that's worth 800. One of the reasons you're going to get better terms is now your LTV is lower than 75, most likely, and you're removing the mortgage insurance. You're down to 6.5%, or who knows what future rates are, but it ends up being something that works out really well for people, I'm sure. And so yeah, cash in refinance in lieu of the recast, which some people use as an option. Awesome, man. I'm looking forward to a lot of conversations, because this is a position so many people are in. And so, my advice to people who are listening to this, if you're a client looking into it, if you're a realtor looking into it, like most loan products, it's not for everybody, but it might be the option that best suits you. If you're in any sort of market where the forward purchase is going to be competitive, it might be really hard to buy something contingent. It might be something that, not only would your offer have to be substantially higher to get your offer accepted, it might not get accepted at all. So this might be something that at least puts you in the game, right? You might not be in the game offering contingent. And then, as much as there's parts of this where you're like, oh man, I got to pay a fee, or I got to do this. Well, what if you sold the house you're leaving for 25 grand more because you sold it cleared out and staged, and maybe you buy forward in January, get a great deal, and then you sell your place in May, as the flowers are blooming in Sacramento, and you get a higher sale price, because that's the one question I forgot to ask, Tyson. The fee involved with setting this whole thing up is a percentage of the sale?
Percentage of the loan amount. Yeah. So
okay.
The sale, I want that to be untapped. The way we look at it, we want that sale to be untapped. That's your equity, not ours. We charge 2.25% of the loan amount on the bridge loan. So
okay.
the lender's getting that. I can go into the nitty gritty behind that, but that's kind of a blanket percentage across in any bridge loan that we're doing.
Okay. Yeah. What's funny? I don't know if it was another company or something, but I thought I remember a 2.7% number. So 2.25. I already feel like I'm getting a good deal. And it's on that 450, which is correct. The bridge loan plus the payoff of the original, not on the sales price. See, I'm getting a better deal both ways.
I feel it.
I feel good about it, man. Any parting thoughts or advice or piece of info we might have missed here?
I was going to hit on the points, so I'm glad that you brought that up. No, I would just tell you that I think the best way to use the bridge loan is to have some foresight with it. To jump in, both feet in. I would tell you and the viewers that probably half the calls I get on a bridge loan comes from a chain of contingency. So if my house is the house that I'm selling for $600,000 and I'm purchasing the $800,000 house, say I didn't know about Boost, and I came in with a contingent offer, and someone came in and they're buying my house, and for whatever reason their financing fell out. I can't do anything to control that. I could have the best lender or realtor in the world, and sometimes that happens. And frankly, it puts me in a very inopportune position, because now I'm trying to sort out my purchase that I'm contingent on, that I've met contingencies on, that I have earnest money into, and I don't have the assets to do it. And so, I mean, the Boost is great to come in and save the day in that case. It's also great to plan ahead and have the Boost loan to roll, so you don't have to go through the stress, and you can avoid that altogether. It's already handled.
Awesome.
Yeah.
All right, cool. Well, with that, if you want to connect with me and my team, we're licensed in 48 states. Greatmortgagebroker.com. Fill out the quick form. I'll, like Tyson said, do some planning with you and look into the future, see if it's a good fit for you in your scenario. And if it is a good fit, run you through some of these numbers. As a math nerd, I love that stuff. If it is a fit, we put it together, we send it on over to Lensure, and they do the heavy lifting. We get you into the new house, and everybody wins. So thanks, Tyson. I appreciate your time today, brother.
Thank you.